Hello, and welcome to Enterprising Investor, CFA Institute's flagship podcast. I'm Cathy Scott, and I'm editor of Enterprising Investor blog. And joining me today is Raluca Filip, who's a CFA charter holder, and her role in the industry is to work with financial advisors to help them improve their clients' decision-making, particularly under pressure. And Raluca's been writing a series of blogs for Enterprising Investor on this very topic. Today, we're going to focus on how to manage through a client's hesitation and reversals. And we all know that these are very common during periods of elevated volatility and rapid news cycles. Raluca, welcome.
Thank you for this introduction, Cathy. And yes, you very well captured that part of my work is very much focused on financial advisors. And as you say, basically empowering clients to make better decisions.
Great. Well, let's start out with the assumption that advisors often have around clients who change their minds about their risk tolerance, right? In your experience, what's actually happening at that moment when a client changes their attitude towards risk?
Mhm. Well, I think it's fairly normal and let's say human. I mean, when we enter a relationship, when we enter a market portfolio, or even our relationship with the advisor, we come with a set of expectations that in general have been informed or built based on our recent experience. If we take the current context, most of the clients who started investing over the last few years have built expectations that are rather bullish, and in that sense, they might underestimate risk or they might underappreciate their resistance to volatility. It's one thing to just imagine how a market drop will be, and it's another thing actually living through it. So even though in general advisors do take their clients through different risk questionnaires and try as much as possible to anticipate what the reactions are going to be to a market drop, that's very different from actually living through that reality and actually seeing your portfolio in red. So I think it's very normal that it happens. Having said that, I think there are some steps that advisors can take to better prepare clients for those moments and to better appreciate the real risk appetite of the clients.
And what are those steps? If I'm an advisor and I get a panicked call from a client, and I want to make some changes to my portfolio, probably in response to some market news, what is the first thing I should do as an advisor? I assume it's listen.
Mhm. Well, I think first we have to distinguish between what an advisor can do at the start of the relationship and then what they can do when the sell-off actually happens. To answer your question on the second part, basically at that moment, the best thing that an advisor can do, and it's quite easy to implement, it's yes, as you say, you have to reason with the client, understand their emotional fatigue and what they are going through, and after you build that bridge, basically, yes, I understand you are panicking. It's not very nice to see everything falling. You are down 20% or whatever the percentage is. Then redirect their attention on what was the purpose of that portfolio. And here they can ask a simple question like, let's step back for a moment and just remember what was the initial purpose of this portfolio. What were you trying to achieve when you first built this portfolio, when we agreed on the investment strategy or asset allocation? And usually, that simple question already gives clients a pause. They need to pause a bit and step away from their emotionally charged situation. Actually, it usually takes a bit of time for them to come up with an answer. In itself, it's showing us that it's forcing their thinking out of the state they are currently in, and that alone can totally change the conversation. Imagine, as you say, the client is calling, is panicking, they're thinking about selling, or maybe they're just looking for some advice from the advisor, and you ask them, okay, I understand, let's remember what is the purpose of this portfolio. And they say, I don't know, it was building financial freedom when I retire, or being able to retire when I'm 50, 60, whatever their goal is. Okay, that's very good. So what do you want to build actually in the long term? So you are redirecting the conversation, and gradually, usually the client itself start to realize that they were just overreacting. That in the longer term, selling now or doing anything now in the portfolio can actually harm their portfolio and the purpose, the objective of the portfolio.
So, how important is it that you actually ask that question and step back and wait for the answer versus just giving the client the answer that you know?
That's a very good question. It's very important. And actually asking questions rather than giving answers, it's very important. Because when you ask the question, you are basically directing the client to find the answers, and that will change their perception much better than you actually giving the information. Because if they are in a state where they can't actually hear you, even if you say the same thing, okay, the advisor maybe could have opened the client file and say, listen, I know you are overreacting now. Remember, this portfolio was actually built for your pension. But the client was still in an emotional state. So even though technically speaking, the information would have been the same, the impact would be very different because it wasn't the client's answer, it was an information given in a state where they weren't actually being 100% rational. So subconsciously, let's say it wouldn't land. Questions in general work much better than giving answers and giving, let's say, data or information. You can, of course, give data and information and start mentioning long term returns and so on, and refer to past crises and recoveries, but only after you see that the client shifted, that they reconnected to the longer term strategy.
So that sounds like a very reasonable first step. What's the next step? And particularly with a client who's not really playing that game, right? I just can't see past my panic at the moment. What would be the next step, the second and third step, if you will, for the advisor?
Well, if they can't see past that panicking, the advisor has to show some patience and insist on that. Maybe taking it in smaller steps and ask them, okay, let's imagine we sell this now, and in 3 years the markets recovered. You would have missed that spot. How would that make you feel? How would that impact your longer term strategy? So you can do what is commonly called a pre-mortem. Imagine an alternative future, let's say when they acted as they wanted now, and see the consequences of that decision. That would be an alternative. But in general, I haven't seen clients who don't manage to actually reply on the first question, because it is related at the end of the day to the motivation. Why did they actually enter the investment world in the first place? So it's reconnecting to their motivation, their drive, what actually made them take that initial step.
So it sounds like what you do draws a lot from behavioral finance, but there are other what else do you draw on? What other fields do you draw on in your practice?
Yes, behavioral finance would be one. Let's say I took and adapt practices from coaching, business coaching or personal coaching, and in general, understanding the power of language. And here, yes, there are different fields of study or body of knowledge, let's say, not necessarily study, like neuro linguistic programming, lateral thinking. The work of Edward de Bono, for example, inspired me very much. In general, it shows us that the words we choose and the questions we ask can make a big difference in the way we see a situation, we perceive the situation. And what I usually emphasize with my clients is that we tend to think of questions like way of getting answers. But the real power of questions lies in the fact that they're actually directing the attention. That's why, as I mentioned, asking clients some purposeful questions can have much better results than giving them information and data and the answers.
So I did notice that you submitted another blog for Enterprising Investor. Do you want to give us a little preview about the focus of that post?
Yes, it's something that I found very relevant given the current situation. Just to give some context to the listeners, what I've been thinking over the past few days and even weeks, it's this idea of the general advice that markets recover through sell-offs, which is generally true and a very, say, data-based advice. At the same time, I think it underestimates the tail risk, or maybe not underestimates, but it doesn't explicitly consider the tail risk. By tail risk, I mean, say, the black swans that happen from time to time, or specific event that has a low probability but can lead to a significant capital loss. And of course, this became more and more preoccupying for me, seeing that have not only uncertainty that prevails, but increasing geopolitical risk, commercial wars, and so on. So yes, basically what I've been trying to put down, and I must confess this especially as a personal preoccupation. I mean, for my own finances and my own decision making, is how can actually one reconcile these two worlds, meaning a world when, or a possibility, a future scenario where the world continues as we know it, and yes, markets recover through the sell-offs and so on, but also a scenario which, yes, it remains a low probability, but in my view, it's not a zero probability scenario where we actually all the situation degenerates gradually to a deeper geopolitical conflict, more permanent supply chain disruptions, and so on, which eventually can lead maybe to a new world order, as Ray Dalio puts it. So what I tried to think through over the last few weeks especially was, how do you actually manage your money, or how do you actually make a decision where, yes, world A remains the most likely scenario, but at the same time you can't completely rule out a change in world order.
So, what's the key takeaway? Where did you land on that idea of how to manage through those two very different potential futures?
Well, the idea, and this is not actually invented by me, but the answer I came to is to have a barbell portfolio, meaning that most of the allocation will go to assets which would perform well if the current world order prevails, but at the same time have a allocation to assets that will give a buffer if it doesn't. And yes, this would typically be what we consider, let's say, safe haven, or not necessarily safe haven, but assets that are more protected from geopolitical risk. And the main idea here is that the focus shouldn't be as much on maximizing returns, but also on protecting yourself from total capital loss. Yes, if we accept the idea that the drawdown is temporary, you will recover. Of course, now you also have to account for what is your investment horizon time and so on. It's one thing if you are 40 and another if you are 60. But yes, not only maximizing return, but protecting yourself. And I like to consider it like, as well, let's say, an insurance premium. Yes, I won't participate in a recovery 100% in the recovery, but at the same time I don't risk becoming bankrupt if the recovery doesn't happen. So it's like balancing the different scenarios.
Okay, fair enough. Well, we look forward to that, publishing that on Enterprising Investor blog. So, tell us a little bit about the other part of your business, which is not necessarily helping financial advisors manage to do their clients' decision making, but also, I believe, organizations and advisors themselves that managing themselves.
Yes, basically my whole current work is built around the idea that I believe strongly that our success depends on the quality of our decisions, and that quality of decisions doesn't depend only on our expertise and knowledge and know-how. It also depends on how aware we are on how we use that knowledge, meaning that subconsciously we all have different mental filters. We have, let's say, rules of the mind that we form over time. As you know, some of us are more attuned to seeing opportunities, some of us are better at spotting risks, some of us are more into the global picture, and so on. So our minds are wired in different ways. And until we are fully aware of how this happens for each of us, it can become blind spot. in general, these mental rules would serve us well, but as well they can put us make us more open to different biases. So the core of my work is basically to help companies and the leaders to protect their success by understanding how the decisions form in their mind and how to gain more perspectives. Basically to start seeing the data, the context, I don't know, the problems they have to decide on from more angles than they would normally do. It's like you start seeing what lenses you have, but you also gain ways of changing those lenses. And that's basically what I try to do.
And finally, what's the most common emotional bias?
The most emotional bias I see among the C-level doesn't actually look emotional, but it's actually a need of control that manifests itself as being very decisive. And on the face of it, it doesn't look like a bias, but it actually reflects a tendency that in general C managers have of being very action prone, taking action quickly, deciding quickly so that they can move on. And this is very useful in many contexts, but unless they have full control, let's say, over it, or better said, full visibility over it, it can become impulsiveness. Okay, we say we are action takers, but sometimes we end up rushing into decisions, or we end up forming opinions too quickly and then becoming reluctant to revising them, or we don't listen, we don't really listen to the advice of those around us. So this is something that I see very, very often among C managers. It's one of the biggest aha moments, let's say. And I can say it was for me personally as well, because all of my life I consider myself to be proactive and so on, but I never realized that this can also make me rush into decisions. Yeah, I was only seeing the upside of it, not the downside.
I get it. I'm sure a lot of our listeners can relate to that. So the one thing I can do immediately is to pause.
Yes, and actually, through speaking of pause, through experience, many leaders learn, let's say, to sleep on a decision, because they sometimes they do realize that they rushed, so they impose on themselves to let me sleep on a decision rather than decide today. And sometimes it works. The problem is that if you sleep on a decision and you wake up with the same lenses, as I said, you won't see things very much different. Maybe your perspective is gonna change if it was the decision was, let's say, more emotionally driven, but it is actually something you perceive differently in I don't know, the risk, the opportunity, the context. It won't change just because you slept on it. That's where it's important to be able to ask yourself different questions.
Great. Well, thank you very much for joining us today, Raluca. And we look forward to your ongoing series in Enterprising Investor.
Thank you very much.